What if everything you thought you knew about silver was wrong? What if the story of silver rings and coins is a complete distraction from the real game? Because right now, as we speak, there's a silent war being fought for one of the most critical metals on Earth. And the battleground isn't the jewelry store. It's the solar farm, the electric car factory, and the AI data center. While everyone was arguing about tech stocks and the Fed, the best performing major asset of 2025 quietly went thermonuclear. Silver, up 115% in 1 year. It didn't just beat the market, it humiliated it. This isn't a fluke. This is a fundamental structural regime change. And today, I'm going to show you exactly who's buying all the silver, why the price isn't stopping at $66, and the mathematical pathway that makes $100 not a question of if, but when. Stick around, because what you learn in the next will change how you see this metal forever. The big lie: silver is not a precious metal anymore. Let's start by dismantling the biggest myth. For decades, the narrative was simple. Silver is a precious metal. Its value is tied to jewelry, silverware, and coins. But that story is dead. The data killed it. According to the 2025 World Silver Survey, jewelry now accounts for just 18% of total global silver demand. 18%! A decade ago, it was over 30%. So where did that demand go? It didn't vanish. It was stolen. It was stolen by the new economy, by the green revolution, by the arms race. The other 82%, the overwhelming majority, is now consumed by industry. And this isn't just buying, this is structural, inelastic consumption. This shift changes everything about the investment case for silver. It's no longer just a shiny metal you bury in the backyard. It's a critical industrial component, as essential to modern tech as silicon is to a computer chip. The three titans. Who's really buying all the silver? So, who are these new titans of demand? Let's meet them. First, the tech and green energy duopoly. This is the 800-pound gorilla consuming 38% of all silver. First, electronics. Every smartphone, every AI server in those massive data centers uses silver in its circuits. As we cram more AI into everything, the silver content per device goes up. Samsung plans to embed AI into 400 million devices in 2025. That's millions of ounces, from tiny amounts that add up fast. But the real rocket fuel is solar power. In 2024, solar panels absorbed nearly 200 million ounces of silver. Why? Every single panel needs it for the conductive paste that makes it work. And here's the killer point. Even though they are getting better at using less silver per panel, a process called thrifting, they are installing so many more panels globally that total demand keeps screaming higher. The International Energy Agency projects thousands of new gigawatts of solar by 2030. The math is undeniable. Second, the electric vehicle juggernaut. This is the fastest growing demand source. A traditional gas car has about 1528 grams of silver. A hybrid, 1834 grams. A full battery electric vehicle, 2550 grams, nearly double. That silver is in the battery management, the power electronics, the charging port. By 2027, EVs will be the primary driver of automotive silver demand. This isn't a trend, it's a total transportation overhaul, and silver is a non-negotiable passenger. Third, the shadow buyer, defense and aerospace. This is the most secretive, price-insensitive buyer. Exact numbers are hidden, but the evidence is staggering. Reports suggest a single Tomahawk cruise missile contains 500 ounces of silver that vaporizes on impact, gone forever. Modern military drones, next-gen submarines that need 3 or 8 tons of silver each, advanced aircraft like the F-35, and thousands of satellites like Starlink, 6 to 18 kilo each, all rely on silver's unique properties. Global defense spending is hitting record highs. This demand doesn't care about the price. Performance is all that matters. The perfect storm. Squeeze, dynamics, and the ratio collapse. Now, take these 3 insatiable buyers and drop them into a market that's been in a structural deficit for 4 consecutive years. Demand has exceeded new mine supply and recycling. The cupboard is getting bare. This has led to heavy drawdowns in the warehouses where traders get physical metal, like the COMEX. Registered inventories have fallen to levels that represent just days of global industrial consumption. This is the physical squeeze in action. And then there's the most beautiful chart for silver bulls, the gold to silver ratio. A year ago, it took 85 ounces of silver to buy 1 ounce of gold. Today, just 65. This 24% collapse means silver is dramatically outperforming even gold at its all-time highs. Historically, in true monetary metals manias, this ratio doesn't stop at 65. It goes to 30 or even 15. Let's do the simple math. The $100 pathway. Mathematics, not magic. So how do we get from $66 to $100? It's not hope. It's a simple equation. Layer 1, the macro tailwind. Negative real interest rates, currency debasement, geopolitical fear. This drives money into hard assets. Silver benefits more than gold due to its smaller, tighter market. Layer 2, the unresolved physical squeeze. Mine supply is stagnant. A major new mine takes 5 to 10 years to build. The deficits we see today are the result of decisions made a decade ago. The supply simply cannot respond fast enough. Layer 3, the momentum catalyst. At $66 with 115% gains, silver is now on the front page. This triggers a FOMO feedback loop. Retail buys physical, premiums rise, the gap between paper and physical metal widens, and algorithms chasing momentum pile in. Put it together. A 50% move from 66, which is a completely normal volatility swing for silver in a bull market, lands you at 99, rounded up. $100 silver, is it guaranteed? No. The risks are a sky-high dollar, a shock interest rate hike, or a miracle mine discovery. But the probability, given the structural demand, is higher than most people think. How to think about silver now? Here's the bottom line. The silver market has fundamentally changed. It's a hybrid, part monetary metal, part essential industrial commodity. This dual nature creates a more explosive upside than gold during periods like this. For the long-term stackers who accumulated during the boring years, this is your validation. You weren't crazy, you were early. And being early looks a lot like being right, given enough time. For everyone else, you need to think strategically. Physical. First, treat physical silver as wealth insurance. It's the base layer that has no counterparty risk. Use pullbacks. Volatility is your friend. Use dips toward the low 60s as opportunities to build a position methodically. Satellite plays. Consider ETFs or mining stocks for tactical exposure, but don't confuse them with owning the real metal. The mantra is, stack for preservation first, speculation second. The $100 silver countdown isn't just a headline. It's a mathematical outcome gathering momentum from industrial deficits, a collapsing ratio, and a fundamental regime change that Wall Street is just starting to understand. What do you think? Which of the three titans, tech, green energy, EVs, or defense, will be the biggest demand surprise of 2026? Let me know in the comments below. If you want to follow these macro shifts with me, smash that subscribe button and hit the bell so you don't miss our breakdown of the key indicators like COMEX inventories and lease rates that will signal the next big move. Thanks for watching. Until next time, stay sharp.